Welcome, everybody. I want to welcome everybody to our economic forecast event. I want to thank all our sponsors for making this event possible. Our gold sponsors, FBN, North Star Insurance, Closet and Storage Concepts, Streamline Communities, Mason AHT Insurance, Divine Stoneworks, Anderson Windows, and Fairview Millwork. Our blue sponsors are Trask Development, Quincy Chamber of Commerce, Prudential, GCP Applied Technologies, and the Home Builders and Remodelers of Massachusetts. So welcome to all of our sponsors, and I want to thank all our members and especially my fellow board members who have supported this organization on the local, state, and national levels. I think this has allowed us to provide services to our members and valuable information dealing with the events of last year. And I hope we can all be more successful in 2021. Now I'd like to introduce today's keynote speaker, which is why we're all here, Dr. Robert Dietz. He is Chief Economic and Senior Vice President of Economics and Housing Policy for the National Association of Home Builders, where his responsibilities include housing market analysis, economic forecasting, and industry surveys, and housing policy research, which he's published academic research on the benefits of home ownership, federal tax policies, and other housing industries, and has testified before Congress on real estate policy issues. So I'd like to introduce here Dr. Robert Dietz. Thank you, Pete, everyone.
Great. Thank you very much, David. And I want to thank Scott and the association for inviting me to speak to you today. We were joking before I came online that NAHB, Washington, D.C. experienced the storm yesterday. My kids are home from school. There's virtually no snow on the ground. That's what it takes to close schools here in D.C. Not very much at all. So, I'm glad to be able to join you today. I thank the sponsors. I'm going to go ahead and share my presentation here, and let's see. I hope everyone can see it. This is a great platform, by the way. I've really enjoyed using it. So, in terms of where the current economic outlook is, housing has been the bright spot of what is now a recovering economy. I think with the deployment of the vaccine, we're going to see gradual improvement in 2021. We still have a couple of tough months ahead of ourselves in terms of the challenge of the virus, but generally speaking, we're looking at three historic data signals right now in terms of the strength of the housing market. And the first was that the NAHB Wells Fargo Housing Market Index, which is a measure of builder confidence, in November, it hit a level of 90, which was an all-time high. Now, just a couple of days ago, it did decline to a level of 86, but that's still the second highest on record. So builder confidence is very strong. Another historic data signal that we're watching, we've got the level of pricing for resale or existing homes is real near the median price of newly built homes. Now, typically, and it makes sense, newly built homes should have a price premium or a higher price because they're newer and they offer better amenities and have lower cost of operation. But the inventory of existing homes right now nationwide is so tight that we've seen 8 to 9% price gains thus far this year. And so it's pushed up the value of resale homes real close to new. And it's a true signal of how strong housing demand is. We also have the largest ever gap between the current pace of new home sales and the production of for sale single family housing. Now, this is going to have two impacts. It's a sign of housing strength, but we do expect it means that new home sales growth will slow. It'll still grow, but it's going to grow at a slowing rate in 2021. And we're going to need some additional gains in construction in order to reduce the backlog of that gap between sales and starts. Of course, we have supply chain issues. The most important are the fact that lumber prices went up earlier in the year. They were actually coming down over the last 6 weeks or so, but now lumber prices are going back up again. And it's not just lumber. It's a variety of different building material issues, including the fact that delivery times have been extended. That means construction times are taking longer, and the costs for development have gone up. So overall, demand is strong. We see a suburban shift, and I'm going to walk you through some of that data that is benefiting home building because we see housing demand moving out to lower density markets. We have a growth in work from home, And yes, some of that is going to roll back as we get a mass deployed vaccine. But we've got survey data that suggests about 60% of people who are now working at home, at least part-time, expect to continue to do so on a part-time basis next year. And that means they can live further out, and that's a bullish indicator for home building. Historically low interest rates are going to continue, and that has supported housing demand. And then we have favorable demographics. The millennials are moving into their late 30s, their early 40s, and as they do so, the demand for single-family housing is going to go up as we move forward in time. So let's start with the overall macroeconomy. You can see the real impact that the virus crisis, and in particular the lockdowns, and by the way, I'm not going to get into the debate of whether the lockdowns were efficient. I have my own opinions as an economist. I'm not a public health expert by any means, but I do think we're going to look back in a couple of years with data and say, were these most efficient strategies that we could have pursued? But putting that to the side for a moment, the second quarter GDP growth rate was down about 30%. In the third quarter, we had about a 30% gain, and that's about as close to a V-shaped recovery as you can obtain. So the economy had a lot of momentum going into the downturn, and it really staged a fairly strong rebound in the third quarter. For the fourth quarter, we're expecting GDP growth somewhere between 4 and 5%. Now, we expect that growth rate to slow in the first quarter and the second quarter of 2021, and you can see that it's the second and third blue bar after that red vertical line on the slide. We think the growth rate, again, will be about between 2 and 3%, and that's a reflection of some of the job losses that we're seeing right now, as some parts of the country, including California, most notably right now, experienced accelerated job losses due to renewed lockdowns and limitations on economic activity. But then if you look at those blue bars for the third quarter and the fourth quarter of 2021, we have growth accelerating, and that's the impact of a mass deployed vaccine. In fact, our forecast assumes that by the end of April, 50% of the U.S. population under Operation Warp Speed will be vaccinated. And in fact, probably by October, 75% of the U.S. population. That really should bring down some of the costly economic public health strategies and then give renewed incentives for investment and for reopening of the overall economy, including those sectors like travel, tourism, and hospitality that have had persistent weakness. So growth will accelerate during the second half of 2021. And for the year, we think the GDP growth rate is going to be about 4%, a little bit slower in 2022. And I will say there is a headline risk to those growth forecasts, and that's if we get an overstep on regulatory policy in Washington, D.C., as a consequence of the change in the White House. So we're going to be watching those labor and environmental rules in particular that really could slow down some of that business-led rebound that we expect to take hold during the second half of 2021. Now, when we look at some of the macro data, we've been using an example using restaurant sales and grocery store sales as a way to learn about what the economy experienced overall during the virus crisis. You can see on this slide that the red line is restaurant sales, the blue line is grocery store sales, pretty stable. In fact, the two lines actually crossed in 2015 when restaurant sales actually overtook grocery store sales. But then look what happened as we went into 2020. Restaurant sales fall in half there on the red line. Grocery store sales surged in the spring back when the shelves weren't empty, but for a lot of products, you couldn't find exactly what you wanted. And then after that disruption effect, you get a stabilization effect. The data series kind of go back to where they were, but with some permanent, persistent changes. And for this particular two data series, the persistent change is the fact that grocery store sales are now higher than restaurant store sales. And we think that's a good analogy for what we see for the overall economy. And, for example, when we look at overall services and overall goods purchases in GDP data for the U.S. economy, you can see the declines that happened in the spring, the rebounds, but look at the relative sizes of these two sectors. The goods economy, which would include a lot of the housing market, is larger than it was at the start of 2020. The service economy is smaller. And we see those kinds of trends playing out between residential real estate and non-residential real estate. Housing's been the bright spot. Residential economic investment is higher, and non-residential construction is actually smaller. And that's going to have some profound changes for things like the demand for office space and retail space. So if we take a step back and we look at the labor market, the good news is we never actually got to the 25% unemployment rates that we were talking about in March and April. Secretary Mnuchin, for example, said he was expecting about a 20% unemployment rate. And that really is credit to the administration and to Congress for passing those, the CARES Act, for example, $1 trillion stimulus bill, including things like the PPP programs. So the peak unemployment rate, I think, will be revised, but when they look back with around 16%. And then we saw a really rapid decline in the unemployment rate over the summer as the overall economy began to adjust for what it means to be able to deal with the virus. And right now, the unemployment rate's at 6.7%. That's a lot better than a lot of us thought it was going to be at the end of the year. So it's performed better than we expected. But the rate of improvement from this point forward is going to be slower. And we saw that, for example, in today's jobless claims that ticked higher. So we think the unemployment rate is going to be about 5% by the start of 2022. And the other big policy challenge, something the Biden administration is going to have to tackle, is that you have a growing number of people, 2 to 3 million, who've now been unemployed for 6 months or more. And economic research indicates that when someone has a spell of unemployment that lasts 6 months or more, they change their economic plans in terms of being able to buy a home, rent an apartment, purchase a car, send their kids to college. And so it's that long-term unemployment that's going to have the scarring effect that is going to have to be addressed with policy. Now, looking at the national versus the local data in terms of payroll employment nationwide is down 6%. And by the way, in terms of national employment, the home building sector is one of the few industries right now that's actually larger than it was a year ago. So again, this is what we mean about housing being a bright spot. Now, the Boston data, you can see down about 10% compared to where it was in February as we went into the downturn. This is consistent with what you see in a lot of large metro areas. So it is a larger decline than what we see in terms of the national data, but it is some of the more rural and exurban markets that have done better in terms of the labor market data. If you're looking for places that have really elevated job losses that continue to persist, you need to look at places that have travel and tourism economies. And I'll point out the Las Vegas and Honolulu areas where you have persistent ongoing job losses. In fact, the unemployment rate in Honolulu over the summer was actually about 30%. 1 out of 3 workers being unemployed. So there's a lot of concentrated economic distress in terms of the economic geography. The other factor, and this doesn't get a lot of discussion, but I think it really deserves more attention, is that the impact of the COVID crisis has had on the labor force participation rate. This is the share of workers who either hold a job or are looking for a job. You can see from 2015 to about the start of 2020, it increased from about 62% rate to a 63% rate. And this was good. We had a labor shortage. We need to bring more workers seeking jobs. And then the virus crisis hits. It falls from 63 to about 60%. Now, it has rebounded, but the fact that it's only at 61% and not the 63 that we started the year means that there are millions of workers who essentially have stopped looking for work. This is the explanation for why you can have an economy with both an elevated unemployment rate near 7% and also survey data indicating that a lot of businesses are having trouble filling jobs. Now, some of it is a skills mismatch, but the fact that you have those workers that have left the labor market and aren't looking for a job is a key challenge. And by the way, one of the reasons for this, I think, is connected to the reopening of the schools. If you have a hybrid learning model, in a typical household, you're going to have a spouse or a relative or someone at home to watch the kids, even as they're learning online through screens. So the challenge with closing the schools, and again, putting to the side whether or not that's an effective antivirus strategy, is that it does bring workers, and particularly female workers, out of the labor force and puts them on the sidelines. And that's a key economic challenge. So I would argue that for policymakers, as we look to 2021, trying to get the schools reopened is an important part of getting labor market recovery. In terms of interest rates, we have an ally in the housing industry with the Federal Reserve. The Fed acted very aggressively back in March. They reduced the Fed funds rate, which is the key short-term interest rate controlled for policy purposes, basically to zero. And we think they're going to hold it at that rate until 2023. And in fact, some forecasts, including Goldman Sachs, suggest that that key interest rate could be at zero until 2025 or even 2026. Now, I think it's unlikely it'll be that low for that long. But nonetheless, when you look at the blue line here, which is the 10-year Treasury rate, and the red line, which is the 30-year fixed rate mortgage, we've basically got historical lows in terms of mortgage rates and the 10-year Treasury. Now, our expectation for next year and going into 2022 is those interest rates will creep higher. They're not going to dramatically change. You can think back to, for example, 2013, and you can see it on this slide when we had the taper tantrum, which is when the Fed said it was going to pull back quantitative easing, which helps keeps long-term interest rates lower. And long-term interest rates, as a result, jumped up about 80 basis points back in 2013, and the housing market went flat for about a year. I don't think that's going to happen. But instead, what will happen is, as GDP growth accelerates, particularly with the deployment of the vaccine in the second half of 2021, those interest rates are going to go higher. Because as you get a full reopening of the economy, the demand for investment is going to go up. And when the demand for investment goes up and growth expectations rise, interest rates go up. That's just a kind of a natural consequence. So you can see the blue line and the red line here. They're trending higher. And so the challenge really from a housing policy perspective and a market forecasting perspective is to what degree in 2021, given the home price gains that we talked about earlier that occurred this year, 8 to 9% gains for resale housing, what degree will some home buyers be priced out of the market? And I think that housing affordability challenge is going to be key going into next year. Now, I mentioned at the beginning, the demographics are really in our favor. Every economist working in housing has some version of this chart. It's the population profile of the United States. The blue line going through the graph is that profile with the numbers at the bottom of the screen equaling age. And then the vertical axis is a count of people. And so I divided it into generational groups. We know, for example, the baby boomers and the millennials are the two largest generational groups that have come through American history. Gen X, my generational group right there in the middle, a smaller generational group, as is Gen Z, and coming behind them, Gen Alpha. So the good news from a home building perspective is that we know about half of newly built home sales are sold to individuals aged 35 to about 55 or 60. So you can see the millennials, again, that leading edge, the millennials right around age 40. As that group moves through the system and ages to the right, the demand for single family housing is going to go up and up and up. And we already have a housing deficit nationwide. It's the reason that the existing home prices have gone up so much this year with low interest rates. So demographics are really moving in our favor. Now, there's clear regional trends in terms of population growth. The U.S. as a whole has seen the population growth rate go down over the last decade. Some of that is a slowdown in immigration. Some of it is a decline in birth rates that particularly occurred right after the Great Recession. And there's clear regional trends. A lot of the population growth in recent years has been in the South and in the West. And when we talk about the West, we're really talking about the mountain states, not necessarily the Pacific Coast states. In fact, California this year actually had a net population loss in terms of the comparison of people moving into the state versus moving out. The Northeast did post a negative population growth rate in 2019. So like the Midwest, a little bit slower growth. But the good news for your market is that Boston has been growing faster than its regional peers. So you've got on the top of this table the U.S. growth rate. You can see Massachusetts slowing down, but Boston as a whole has been doing better than the region as a whole. And that's a consistent story. You see this particularly also in areas like the Midwest, where cities like Columbus, Ohio, Indianapolis, Kansas City have done better than the regions as a whole, which have moved to more of a flat line type condition. So that's generally a good news for housing demand, and is one of the reasons that areas like Boston do experience housing shortages. Those growth rates have been relatively stronger. Now, if we switch from the macro and the demand side over to the supply side, there's a couple of updates on some limiting factors that builders have been dealing with. I would say the most important in 2020 has been the roller coaster ride that lumber prices have taken. And you can see the uptick, for example, from April until about the third week in September. Lumber prices experienced the most rapid rise in price in more than 70 years. And in fact, it peaked at about $955 per thousand board feet, came down over the last 6 weeks, and then unfortunately, we're back to rising again. And some of that is connected to ongoing tariffs on Canadian softwood lumber, although the good news there is that NAHB, through its advocacy efforts, has gotten that tariff rate cut from 20% to 9%. That should help the market, not right away, but eventually down the road. But the bad news is that sawmills report, due to the COVID crisis, particularly in the spread in the rural areas, they are having trouble maintaining their worker shifts, and that is limiting production. So on the slide, I've actually got the data through December 4th, but in the subheading, you can see that the current price on average is about $660 per thousand board feet. So that number has actually come up against the next horizontal line on the slide. And unfortunately, futures markets are suggesting it should go higher than $700 over the next few weeks. In 2021, this will be a key advocacy issue at the NAHB level, not only trying to get a new softwood lumber agreement, but trying to maintain or enact policies that will help us increase the domestic production of lumber. Unfortunately, due to the election results, I think it's going to be more difficult to harvest timber in the United States, just due to the regulatory changes. And while we don't know who's going to be the Secretary of the Interior, for example, in the Biden administration yet, that's going to be a key post to watch, to look at how our forestry management in the United States deals with in 2021. It's something we have not done very well, as the forest fires in the West have certainly attested to. Another limiting factor on the supply side is the ongoing skilled labor shortage. This is JOLTS data that reports the number of open jobs in the overall construction industry. You can kind of view that red line as an intensity measure of where we stand right now with the skilled labor shortage. So you can see it rose coming out of the Great Recession. Actually, for the last 4 years, it's been higher than the peak rate during the building boom in 2007. That's the degree to which the labor shortage has been particular to this cycle after the Great Recession. And then going into 2020, it was already coming down a little bit, and certainly through the rest of 2020, it's come down. It's still elevated compared to historic norms. But what's taking place right now, I mentioned earlier, home building and remodeling actually has more workers than the industry had a year ago, but non-residential construction has lost a number of workers. So the job openings in the non-residential construction sector have brought that red line down. And it's a reminder that with elevated unemployment rates, now is a moment in time to try to bring workers in from the non-residential construction sector into home building, into remodeling, and train them, because we have to increase worker productivity in the sector to address the skilled labor shortage. And another limiting factor, and this is key, and this is the reason that your membership in the local association and the participation at the state association level and joining BuildPAC and NAHB is so key, is that regulatory costs are a key limiting factor in terms of adding housing supply. And so this is a study that my team did in 2016. We found about a quarter of a single-family home typical purchase price is made up of regulatory costs. So if we could reduce those, we could find a way of bending the cost curve and improving housing affordability. Now, we do this study every 5 years, so we're going to replicate it again in 2021, and I think the timing couldn't be better. Because I've mentioned before, I do think as a result of the election, we're going to see stalling on debates on things like tax policy and legislative policy in Congress. but it's going to be executive orders and regulatory policy where the industry is going to see the most negative changes from the policy front. And so making the argument about trying to improve housing affordability, trying to improve housing attainability for people trying to become homeowners is going to be a story about fighting additional regulatory burdens in building codes, in land use, with EPA rules. And so some examples of rules that we're likely to see some additional debate on in 2021 are the rules that we saw in 2015. Things like Waters of the U.S. rule that deals with clean water permits, the joint employer rule in terms of the relationship between general contractors and subcontractors, independent contractor misclassification. All of those factors have the potential to drive up costs and increase regulatory burdens and hurt housing affordability. And that's going to be a key message that we're going to have to take to policymakers, again, at the local, the state, and the federal level. And I've mentioned this repeatedly, but housing affordability really is the story. And there's actually a kind of a debate right now in the housing economics community among my peers that do housing and economics research about the conditions of housing affordability. There are indices out there right now that say housing affordability is improved. And the reason why is we have low interest rates. Lower interest rates reduce the cost of trying to buy a home. What you're seeing here is something we call the Housing Opportunity Index that my team produces with Wells Fargo. And the numbers reflect the percent of new and existing home sales that are affordable for a typical household, a household right in the middle of the income distribution. So you can see the downward trend here. In fact, for the national data, only about 58% of new and existing home sales were affordable for a typical family as of the third quarter of 2020. For Boston, the affordability conditions are even more binding. This is not a surprise to you. Only 42% of new and existing home sales that occurred locally are affordable for a typical family in the local Boston MSA. And it's those long-term declines that really have formed the basis of our advocacy argument about the improvements that we need on the policy side to try to improve housing affordability. And my concern is that the home price growth that we've seen this year, which has been great and allowed builders to cover some of those increases in input costs, homeowners have certainly celebrated the rise in home prices, but they have the ability to price out households from being able to participate in the market in 2021. And so if you go all the way back to when we were talking about macro conditions and the fact that interest rates are likely to rise, the combination of even slight increases in interest rates and ongoing home price appreciation does have the ability to stall the market somewhat. Now, when I give you my forecast in terms of the production data, I'll show that on net we think the industry is going to grow. But that's the warning. That's the thing that we need to be focused on, and particularly on the policy side. All right, so let's transition then into the forecast. This is one of those historic data signals I mentioned at the very beginning. The red line here is new home sales as measured by the Census Bureau. The blue line is a measure that I created a few months ago, and it's from the housing starts report that the Census Bureau publishes on a monthly basis. But I filtered out using some statistics. I filtered out custom sales and single family built for rent. So I left just single family for sale starts. You can see the blue and the red line typically move together. One place where there was a notable gap, for example, is 2009, where the blue line went down lower as we underbuilt in order to try to work off some of the excess inventory that built up during the Great Recession. Look at the very end of this slide. So the red line here currently in the second half of 2020 is well above the blue line. And that's what I said at the very beginning of this presentation, that we have a historic gap right now between sales and for sale construction starts. In fact, in the October data, if you look at the data, you find that there was a 100% gain in the number of homes that were sold that haven't even started construction yet. So there's a pretty extensive backlog in terms of the match between sales and starts. And again, I do think this means that we're going to see a slowing of sales growth because the industry does not want to get out ahead of its skis, so to speak, and sell homes that haven't started construction. And then we're going to need a catch up in housing starts in terms of trying to work off some of that backlog. So in terms of builder confidence, this is our flagship measure. It's the monthly builder confidence measure, the housing market index that we do with Wells Fargo. In November, it was at a level of 90. Now, it just came out yesterday, but it dropped to a level of 86. Still the second highest reading on record. And we designed this index, it's a 0 to 100 scale. Anything above 50 is positive. And it's intended to kind of telegraph where we think what you see in red on this slide, where single family starts are going. So even dropping down to 86, it suggests that we should continue to see modest gains in single family construction going forward. And here's our forecast. 2020, we think we're going to end the year about 11% higher than where we were in 2019 when the full data are in. And that's a remarkable gain. So if you go back to my forecast from January 2020, before we were really kind of seriously considering the impact the virus would have on the economy, we were expecting only a 3 to 4% gain in single family starts. So an 11% gain. It's been a really surprising, positive year for home building because of the impacts of the virus on, for example, the geography of housing demand. We think that growth rate is going to slow in 2021. It's going to slow to about a 5% rate. And if you look at that blue line in terms of what we think is going to happen with the production of single family homes, we're at a peak right now, and we're going to have a little bit of some choppy conditions at the start of 2021. And then we're going to get back to the long run trend that we've basically been on since 2011. So a 5% gain, it will push us over 1 million single family starts in 2021. That'll be the first time that's happened since the Great Recession. And then about a 3% growth rate in 2022. And if we look at the local data, you see kind of, a little bit of a gain this year, not quite as high as the nationwide numbers indicate. Boston's on path right now to post for the entire metropolitan statistical area about a 3% gain in single family permits, a little bit higher for the state as a whole. We do see some of these outlying areas seeing some additional growth. And as long as the population growth rates trend in the direction that we saw in the earlier slide, we should see some additional growth going forward, provided the regulatory policy permits it. In terms of some trends, we said at the start of the year, we thought the new single-family home size was going to level off and then begin to increase. And that's important because for the last 4 or 5 years, single-family home size has actually been going down as we built more entry-level housing. And if we look at the 2020 data, it's a little difficult to see, but at the very end of the slide, you can see both of those lines kind of leveling off. And then we think in 2021, new home size is going to begin to increase. And a consequence of the fact that people want larger homes, in some cases, they want to move out of those hyper high density markets like New York and San Francisco, is this suburban shift idea. So this comes from our NAHB Home Building Geography Index. I'm going to take you through a couple of maps very quickly that shows the fact that the growth rates in terms of single family construction right now are higher in lower density markets. So the counties in blue here represent the core counties of the United States, highest density, more than 1 million population. And over the last 4 quarters, these areas in aggregate, so bundling them all together, grew at about a 5.7% growth rate. So if we take a step out to the suburbs from these areas, we should see that 5.7% growth rate go up. So we see that here. We take a step out. These are now the suburbs of those large metro areas. And yeah, the growth rate over the last 4 quarters is now up to 10.8%. So a direct correlation between core counties and suburban counties in terms of growth. What's interesting is if you take it even further and move out to small metro core counties, and this represents actually about 30% of single family home building nationwide, these counties in this dark red, the growth rate jumps up to 12%. So these are medium-sized cities, and they're growing even faster still. And in fact, if you take another step out to the exurbs or the outlying counties of these small metros, the growth rate jumps up to a 15% growth rate. So a 1-for-1 direct correlation between density and the growth rate of single-family construction during this time period where we had the virus crisis. Now, I think some of this will roll back after a vaccine, but this suburban shift is real. I think realtors see it, mortgage professionals see it, builders have seen it, and it is benefiting building in the outlying areas of these metro areas. And in the 3rd quarter data of the Geography Index, we actually took a look at counties that are traditional second home counties. So these counties in green are places where at least 15% of the local housing stock consists of a seasonal residence. And these counties represent only about 10% of single-family home building. But look at that year-over-year growth rate in the third quarter. These areas were up 23% year over year. I mean, that's more than twice the growth rate of the overall market. And it's an indication that some baby boomers probably accelerated some of their retirement plans. And yeah, there probably was a shift in terms of some wealthier buyers being able to telecommute full time and move out of their metro markets into some of these seasonal markets. It wasn't just single family construction. We see it in multifamily as well. The map in front of you here represents everything but the large metro core and suburban areas. Only a third of apartment development occurs in these counties identified here, but these areas too were growing faster than the core and suburban counties. So we're seeing apartment construction shift out, and that is going to have an impact on the kinds of apartments being built, more low rise, more garden style apartment. In terms of the local apartment data are typically noisy, but you can see the trends here. Yes, we've got more apartment construction both statewide and in the Boston area. And then the local data confirm what we see nationwide, which is some weakness in terms of apartment construction in 2020. In fact, nationwide, multifamily permits right now are down about 11% year to date. And that informs our forecast in terms of the apartment market, a small decline in 2020, followed by a little bit more than a 10% drop due to that permit weakness in 2021, followed by stabilization in 2022. And keep in mind, in the multifamily market, about 96% of multifamily starts are built for rent. So this is almost entirely a rental story. If we're talking about home ownership opportunities, that's in the single family market with single family detached and townhouse type construction. And I mentioned the fact that geography is affecting the multifamily market. It is going to shift the kinds of multifamily units we build. And I'm a little more bullish on building some of that missing middle, the purple and the green in particular. And maybe we'll see a decline in the blue on this slide, which is the 50 plus unit, larger property, high rise, which market share has gone from 15% 2 decades ago to more than 50% today. I think that's going to shrink as we see a little bit of retreat from some of that density. And then lastly, the remodeling market's had an outstanding year. We're looking at about a 6% inflation adjusted gain for the market this year. And we think that growth will continue into 2021 and 2022. Remodelers face the same challenges as builders, of course, building materials, labor issues. So wrapping it all up, I think it's important to compare the housing market and the commercial construction, non-residential construction market. The housing market's in blue here. It includes single family, apartment construction, remodeling. You can see the little bit of a dip that it took in 2020. And in fact, now it's larger and it will be than the market was at the start of 2020. In contrast, the red is non-residential construction. It's declined in 2020 with the virus crisis. In fact, in our forecast, we think the non-residential construction sector will be smaller for the next 4 to 5 years. So this is a real flip of the Great Recession where the pain was in the housing market. It is now in the non-residential real estate industry. And with that, I want to thank you very much for paying attention and joining us today. My email address is on this slide, as is my Twitter account, Dietz_econ. And all the data that we went through today is updated on a monthly, quarterly, and annual basis on eyeonhousing.org, which is our NAHB economics blog. And with that, I think I will turn it over to Scott or David or whoever's going to join us here on stage.
Robert, that was great. Thank you. And I will remind everyone, we are recording this and we will be able to make the presentation available for download once we get a hold of it. And if anybody else has any questions, feel free to put them on the chat or the Q&A. This is from Dakota. Any insight to prices? If prices will be held higher since so many people will pay the price, or you think there'll be a leveling of that?
So as I said, in 2020, the data indicates that prices were 8 to 9% higher than they were a year ago. Our forecast model assumes that we'll see that rate of growth slow, like everything else, for 2020. But we're still looking for home prices to rise faster than inflation in 2021. my expectation that home prices will slow down to about a 3 to 4% growth rate next year. So it's slower. That will help on housing affordability, but there will be some price growth to help cover some of those higher construction costs that we do think will continue into next year.
I know you had some slides about the levels of building outside of the inner city parts, and people have been flocking out of the urban areas. Do you see that trend continuing after the pandemic subsides, or do you think people will move back into the urban areas in time?
Yeah, I think it is going to be a trend that persists on a partial basis. And this, to me, is really the story of 2020 in terms of real estate. Just this morning, I saw, I was quoted in a story where they had me and another chief economist debating whether what we've called the suburban shift is a myth or exaggerated. It's not an exodus that was overstated, but there is a clear shift in whether you're looking at moving truck data, the construction permit data that we've taken a look at, vacancy data, rent growth data that's gone soft. So demand has definitely moved out. You hit the important point. To what degree does this continue into, say, the second half of 21 and 2022? And I think the fact that we accomplished about a decade worth of learning by doing with telecommuting means that you're going to have a large number of office workers who aren't going into the office 5 days a week. So if we use some realistic analysis, and we did some survey data suggesting maybe 40% of the workforce is going to work at home, at least 2 days a week, for example, that means that their ability to shift further out within your metro area is increased. And they can vote with their feet against housing affordability. They can vote with their feet against regulatory burdens that are too high in those core areas. And they can live out further in the exurbs. So I think some of that demand does persist, but we are going to get some rolling back of some of that high-rise rental demand because younger workers are still going to want to be in downtown areas where the amenities are real close by. But we're going to have to wait until the end of 2021 for that to occur.
Okay. Has worker productivity improved at all over the last few years?
Yeah, here's the irony. The worker productivity is actually sky high right now. And part of that is every business is trying to find new ways to do things in a more cost-effective way. So from a macro level, the overall economy, worker productivity actually experienced a bump this year. And we'll keep some of those gains. This is one of those pivot points where the technology is not perfect. I think your platform actually is one of the better ones, but I'm sure everybody has been on a virtual meeting that didn't go particularly well. But those productivity gains are going to grow, and they're going to benefit the economy and produce efficiencies. The challenges in the construction market. The construction market productivity has been flat for 2.5 decades, and some of the promised ways that we would get productivity gains in construction, including off-site construction, which right now is only 3% of single-family home building is panelized or modular, hasn't materialized. It's always 2 or 5 years away. The joke about fusion power, for example, is fusion power is always 20 years away every single year. I kind of feel that way a little bit with modular, but here I'll go ahead and I'll double down. I think that the off-site construction share is going to grow from 3 to 5 to 6% over the next 2 years. We'll see if I'm wrong again, but it's out there, and that's one way we can raise worker productivity in the residential construction industry. And with higher productivity, our wages can go up, and that will help also recruit people into the sector.
Mm-hmm. Thank you. And this is from Ted Mahoney. Why did Hart get the remodeling economic forecast wrong?
Kermit? Is that who he was asking about?
I think maybe.
Yeah. So Ted and I had a joke. He was trading emails with me, I don't know, months ago when I was in an airport or something like that. But we had a debate over whether the remodeling market was going to slow as we came into 2020. And look, there were some of the data series, we had a lot of remodeling growth, and it did come back down to the trend. The real surprise for remodeling this year was, after the spring or even during the spring, so many people focused on fixing their homes to work at home, spend more time at home, their kids studying at home, exercising at home, and that has produced a mini boom in terms of remodeling. So the slowdown and Ted said the Harvard, that the Harvard prediction that we would see a real negative decline for 2020 is partly the virus, but I think partly also that they got their forecast wrong and we got it right.
Right. Okay. Any other questions out there? So thank you again. And we have this platform open for a while. So certainly everyone that's here, we're going to return to the floor. So if you want to say goodbye to your table or move to another table and say hello, feel free to. And with that, I thank everybody for being in our economic and housing forecast today. And I thank you very much, Robert, for being with us today. And feel free to find Ted. He's somewhere on and say hello. Thank you.
Thank you, Scott.